Hey, everybody. I wanted to thank you for joining us today. We've got a special guest, Brian McCarthy. Uh, Brian, why don't you tell us a little bit about yourself, who you work with, and what it is that you do in the investing world?
Sure. Thanks, Sean, and appreciate you having me today. Brian McCarthy, I am a managing director with Thoroughbred Advisors. We're an independent financial planning firm, primarily based here in New York. I am a certified financial planner, have been in the industry overall for 19 years. And as alluded to, being a financial planner, I work with a variety of clients, helping them achieve their goals. And obviously, as we've met, working particularly with real estate investors and other professions as well.
No, that's great. And so, what was it that when I first reached out to you to chat about some of this stuff? What was it that kind of caught your interest in terms of investments and kind of what's going on with some of the different alternate asset things that I tend to look at?
Well, in general, let's talk about why we work with this specific type of investor first, and then we'll get into the specifics, right? So, one of the beautiful things about real estate investors and those in that market is that there's so many different avenues to approach. It could be anyone from who's doing a syndicate deal to someone who is a fix and flipper to just a traditional real estate agent who happens to work with a number of different clients who are buying their first home. So there's so many different ways in which we can have a positive outcome in that field that it's a great opportunity for us to go ahead and show our services. Now, in terms of the actual assets and the type of investments, my firm and I, we don't make the specific, in fact, we can't make a specific recommendation as to whether or not something might be a particularly good investment. And I'll give you an example. So you're down in the Texas area. I'm sitting up here in New York. If you're getting into, say, a syndicate deal, I'm not able to do any due diligence on any of your partners or to physically see the property or to make any of these sound judgments. It makes it a little bit more difficult for us to go ahead and say, hey, this is the perfect investment for you. You should really go ahead and do this. What we offer is a combination of where we look at things for our clients of what's your return on investment? What's the net present value of that investment to make sure that it's in alignment with your objectives? So for example, we may run into a client who it's a low risk, high return opportunity. It is a slam dunk. You should hit the bid every single time. However, there may be other planning needs that they have to account for, such as I got to cut my client's tuition check next month. I've got a relative who came down with an illness unexpectedly.
Taxes.
Well, we'll get into taxes later.
Yeah, that's a whole nother bucket of stuff.
That's a whole other can of worms. But in terms of it may not be the right time and the right opportunity, so we approach it from the planning perspective, not from is this a high quality investment or not.
Yeah, no, I get that, and it took me a while to learn that. Working with different financial advisors over the years, that no, they are not going to make specific recommendations. Now I understand why, and it makes perfect sense. And it's just like I can't honestly tell my investors that if this is the absolute best deal for you, you should invest in it. All I can do is present the facts. And then I hope to understand at least a little bit of what is their goal for investing. And really, I look at it, it's kind of in a similar role, other than the fact that I don't have your, years of education and certifications that make me a financial planner. But I hope to understand what is it you're trying to achieve as an investor. And I have several options available. Some of these may make sense for what you're trying to do. I can't make that decision.
Exactly, and that's what it boils down to, right, is we will offer assistance and guidance at every available opportunity, and where we can make a recommendation, we absolutely will. But there are just certain points where we're not able to, or it's outside of our expertise. But that doesn't mean that we can't provide a value to the client to provide assistance to them.
Yeah. So, for example, I know one of my big hot buttons is having the client or the investor understand their risk tolerance. How do you help your clients understand their risk tolerance or their profile?
Yeah, and that's a great question. It comes up at the start of every conversation, and each client's going to have a unique position on risk, obviously, right? You can take an exact clone, you can take twins of two people, and they may have two completely different opinions on it. But it starts with the obvious objective elements of how old is the client, what's their current income, what's their liquid net worth. All of that's going to play a factor into say, hey, is this maybe too much risk for you, or is this honestly not enough risk that you should be taking given your current situation and your current economic outlook? So we take all of that into consideration. But honestly, one of our advantages that we help with our clients is that we find ways to minimize that downside exposure, and we still find ways to create consistent income streams over time. So bottom line, we have an extensive list of questions that we ask to ensure we have a complete and total understanding of their profile. Because more importantly, we want our client to be comfortable with whatever it is that we recommend, right? That's the worst position you can be in, is to say, look, we've made this recommendation and it may be logically the right thing, but if they're not comfortable with it, they're not going to be happy with the end result.
Yeah, and unfortunately, if we could all take emotion out of investing, we would probably have more consistent returns. But being emotional creatures, it's next to impossible to completely, take the emotion out. Well, that's great. So, and this is a little bit of a loaded question. How do you determine a balanced portfolio based on asset type?
You're hitting me with a loaded question, 100% there. And look, for traditional investors, we work with top tier money managers, and we allocate their assets based on a client's risk tolerance. Again, using many of the factors that we just spoke about before, asking those more in-depth questions to understand, hey, this is what we're trying to achieve and how we're able to achieve it. So, I mean, that's a pretty standard answer, and we have a really good due diligence process in order to execute on that. But there are certain instances, particularly within, say, the real estate environment, for example, but also in a common client. So, two examples is the client has a large real estate, holding, right? So they've accumulated a vast number of properties over the years because they've just been active in the market. A client has worked for a company for a number of years, and through stock awards, bonuses, things of that nature, has accumulated a large concentrated position of company stock. There's only so many things that you can do to properly get them balanced and diversified, because we obviously want to minimize taxes, like we spoke about before. And there's reasons why they've held on to some of those pieces. Maybe they've been high performing, maybe they've accumulated a vast amount of wealth. So we do take some of those aspects into consideration, but bottom line, we create ways to take maybe some of these riskier assets and we manage them through other preservation vehicles. And this allows us to maintain that balance while keeping the growth objectives intact, and it reduces the client's overall exposure. So we can come up with creative solutions to manage those scenarios as well.
Yeah, and I know, I'm a math and computer science guy, so, I'm very used to, understand the fact that people will give me what I used to refer to as the standard statistical answer. Well, it depends, because there's so many variables that I know you guys, there's a lot to take in. And, just like every real estate deal is different, every client, every investor is different. And, you gotta work to find, balance for you may be something completely different than balance for me.
Yeah.
And that's what I always tell my investors. I say, look, it's your portfolio, it's your money. You've got to figure out, and that's one of the reasons I really dislike the term passive investor. Passive income is great. I said, you want passive income all day long. I said, but you as an investor should never be passive, especially at the beginning of a deal. You've got to get in there and do your homework. And I said, I don't care what it is you're investing in. You've got to understand it. At a minimum, you've got to be able to answer two key questions. One of them is, how does this thing make me money? And the other one is, how can this thing lose my money? And I said, if you don't know the answer to those two questions, you don't know enough about it to be investing in it.
Yeah, exactly. It's you, and it goes right back to understanding that risk profile. Knowing exactly, am I comfortable if say we have a repeat of 2008? Am I going to be able to hold on to that investment and be okay, or is that going to terrify me? And depending on the answer to that question, we're going to go ahead and take a balanced approach to make sure that the client is comfortable with whatever happens, right? It's, you can take a look at what happened recently within the stock market in 2022 and then what happened in 2023. If you can understand that risk or mitigate that risk, you're going to be in a different position. So understanding, going back to what we were talking about before, managing that emotion is such a key aspect. And we go out of our way. I'm very big on to your point of educating clients, making sure that they understand what they have. And they may not understand all the nooks and crannies and the legalese and some of those things, right? I mean, how many of us have fully read our mortgage documents when we've gone ahead and signed it in front of the attorney?
Almost none.
But the point being is that you at least have an understanding of, I've made a commitment, I'm going to pay this much each month, and this is what I'm going to do. It's a similar aspect in terms of the investment.
No, that's great. You'd mentioned earlier about consistent streams of income. What are some of the streams of income investments that you guys typically recommend?
Yeah, great question. So look, sometimes we use more of the traditional investments such as dividend paying stocks, interest bearing bonds. Depending on where they are, they could be government treasuries, could be munis, all depends. We'll take a look at what their need is. And again, going based on their location, their risk tolerance, et cetera, we're able to go ahead and make some of those recommendations. Another product that we're a huge fan of are annuities. Typically because they have some form of guarantee and there's ways to structure them that can be beneficial to a client. And we offer really three varieties in terms of fixed annuities, which are just straight annual income, indexed annuities, which have some type of typical cap where you can't lose cash value but have some participation in an investment while also driving income, or regular variable annuities where the gains can be higher but the cash value of the contract can go up and down, but each one of them can present a long-term income stream for a client, usually built with some guarantees. So those are options. In addition to that, we'll also use cash value life insurance strategies, particularly because it's a way to minimize taxes. So that's another option that we go ahead and bring to the table. So bottom line, our goal is to maximize the client's income and address other planning concerns along the way. And if we can minimize taxes and guarantee the income stream, that's a win-win.
Yeah. Well, and speaking of taxes, one of my CPAs from years ago was fond of saying, you want to focus on tax avoidance, not tax evasion, because the difference is 20 years in the federal penitentiary.
That's for sure.
So what are some of the tax planning things that you guys talk about or recommend for tax avoidance or tax reduction? Sure.
So let's dive right into that. And it's one of the top questions, if not the top question that we receive from clients in general. The one thing I want to kind of bracket around this, and it's important to understand that we are in a historically low tax environment. Right? I'm going to repeat that. We are in a historically low tax environment. And our top earners may not feel that way when they get to that 37, 39% tax bracket. But when you look at where taxes were 50s, 60s, 70s, 80s,
well, you go back to, I think it was in the 1940s, the highest tax bracket was like 97%, I think.
Mm-hmm. Yeah, and granted, it's completely different times where, because I think in order to trigger it, you had to make over like $1 million or something like that. If you're making $1 million in 1940, it's like making 10 or 20 today.
Oh yeah.
It's a completely different number, but in general, we're just in a historically low environment, and uh, the more I watch what's going on, it seems like there's only one direction. It hasn't gone that way just yet, but it seems like there's only one direction for it to go at this point.
Mhm.
One of the things that is common in our world is how do we get around what's likely coming up with the estate tax issue in 2025, because that provision is set to sunset. I don't want to predict what Congress is going to do, especially since we're in an election year,
Yeah.
regardless of how that plays out. But without congressional intervention, that's going to go ahead and sunset, and it's going to create some significant tax issues long term for many of our clients. So, those are things that we try to prepare around just in general, right? Just from a day-to-day standpoint. But even if the tax environment doesn't change, and let's just say we hold the course, we look for different ways to reduce that regardless. Um, as we get to retirement, a proper distribution strategy is, when and where to pull from different buckets as they've accumulated, whether it's, retirement accounts, traditional investment accounts, whether it's maximizing that real estate income. We look for that proper distribution strategy to make sure, again, to maximize the net income, which is one of the important factors. Someone may go ahead and say, well, I'm making $100,000, but how much of that did you pay in taxes versus, well, I walked away with 80,000 in tax-free income or 100,000 in tax-free income. There's a big difference between the number. Two of the after-tax ways that are traditionally tax-free when you structure the distributions correctly are going back to cash value life insurance. And of course, Roth IRAs are two very common ways that we look to implement for our clients when they're available. And we like to leverage those as much as we can. Bottom line, you mentioned working with your CPA and your tax professional. One of the things that we do is we regularly work with our client CPA and tax professional, in part because where the CPA and the tax professional is so instrumental is they work year to year filing the taxes to go ahead and maximize deductions and reduce your year to year income. But we want to go ahead and work with them to make sure that our long-term plan is not impacted by those, so that we kind of work in harmony so we get the best picture for the client. So look, bottom line within all of this, to sum up, regardless of how you invest and whether you're a real estate investor like you are and many of your partners, whether you're a 1099 contract employee, whether you're a W-2 employee, having a sound financial plan has a significant impact on when and how our clients achieve their goals and maintain their lifestyle. And obviously, we want to go ahead and have them accumulate as much wealth and retain as much wealth as possible.
Yeah. No, that's great, Brian. So, if any of my listeners out there want to get a hold of you, what's the best way for them to reach out to you?
Sure. Best way, and I'll also go ahead and give you our website. You can find us at thoroughbredadvisors.com. You can see my specific webpage, which is thoroughbredadvisors.com/Brian, BRIAN dash McCarthy, McCarthy. They could also go ahead and email me at bmccarthy@thoroughbredadvisors.com. And I'll also go ahead and give my office number, and they can go ahead and call anytime, is 646-704-3044. We're happy to answer any questions and help in any way that we can. We know that this can be a complicated process for many and often have a vast amount of questions. And again, we're here to go ahead and help and educate and make sure that we can go ahead and provide as many services as we can to our clients.
Yeah, no, that's great. And I really appreciate you taking time out of your day. I know you're getting ready to head off to a conference and, juggle 14 other flaming balls. I do really appreciate the time. And then I'm going to go ahead and share my screen here so that we can keep your legal and compliance department happy. Let me know when you see that.
I see it, nice and loud and clear. Thank you, Sean.
Okay, perfect. So everybody, you'll be happy to know I am not going to read this to you. I'm going to leave it on the screen here for a few seconds so that you can pause it and read it at your leisure. But as with any regulated industry, you've got to keep all of the compliance and legal people happy. So that's what we're doing here.
Well, thank you for this, Sean. Thank you for having me on. Very excited to be here. And again, any way that we can help, we'd love to go ahead and provide education to whoever needs it.
Brian, again, thank you so very much.